My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 30 minutes here on Options Guide TV. Today's date is Wednesday, what is it? It's May 8th. That's what it is. 2024. The markets are open. They're rocking and rolling. We have we put two trades on Monday's show. We started with an S&P 500 index trade, which that one's doing just fine. And we might want to just get out of that trade at this point in time. So we'll go back and we're going to review that trade, and we'll look at do we want to close it, what type of orders we should have in, and it just, the trade worked out. Last week we did the same trade, which was a long call spread in the SPX, and we had shenanigans. We had to adjust the trade. The trade worked out fine, but we had to make an adjustment. And the rally going into the end of the week actually saved us in last week's trade. This week the market's just been strong. The chart's been strong. A lot of things look good as far as the technicals of the marketplace. There's still obviously geopolitical concerns. We still have the Fed being wishy-washy on if they're going to cut interest rates or not. And just the economic news is inflation is raising its head again and has potential to dampen the market a little bit more, which has delayed rate cuts and everything to go along with that. So the market, technically, by looking at the S&P 500 index and looking at the chart on Monday, we had a small little breakout that we were kind of in a downtrend, and we got a good solid movement to the upside, not only in the S&P 500 index, but also in the NASDAQ. So decided to stay long the market this week, and we're going to start by reviewing that trade. But we also looked at a trade in Disney. And the Disney trade didn't work out. And I was sad because I really wanted to do a skip strike butterfly, but we ended up with just a standard butterfly on the bull side of things. Disney was down 10% on the open. I feel bad for Disney. And the story, as the Disney turns, it keeps going on with their battle for control of the board, for the streaming wars, for the fact that they are getting in bed with a couple of other major players to come up with a sports channel that's going to be very interesting when they get that conglomerate all together. And Disney just doesn't seem to be able to make any headway. And it's just such a stalwart of the market for so many years and years, and Disney just for some reason just can't break through the headwinds and start going up in the marketplace. So that trade didn't work out, and so now we have a lot of the major mega cap tech stocks have announced. We're getting to the tail end of the earnings season, and we still have the big stock. The big one that everybody has been talking about is NVIDIA. And they're going to be announcing on the 22nd after the close, which I believe is a Wednesday. And we're going to look at a trade that's completely different, a little bit off the wall, but I'd like to try to find scenarios where I can take some of the obscure plays inside the options playbook and try to set one up. So we're going to do something completely different in NVIDIA. We're going to do it on paper. It's not meant to be a recommendation because it's going to be a fairly risky trade. But I'd like to do it with you and watch how it plays out. It's not a trade that I've done, I should say, in a while. It's not a strategy, but I just thought of it the other day with NVIDIA and the volatility that has been in the underlying stock and where it might go next. So here's the way that we're going to approach this. We're going to go to the S&P 500 index, the good old SPX. We're going to pull up the trade from Monday's show. And on Monday's show, we're going to look at those strike prices. So that trade, we looked on that day, the market was at 51.57. And right now we're at 51.86. So we've made a strong move to the upside. since we put on that trade on Monday's show. And we ended up doing an at the money long call spread. In other words, we sold the most at the money option contract, and then we went a little bit in the money and we bought an option contract. So we sold all the juice of that at the money option contract. So let's scroll down and set it up and see exactly where we were at. We did a 10-point wide trade this week. Last week we only did 5, and we paid $5.70 for it. So 10 points minus 570 is 430. So 430 is our maximum upside that we can make. The width of the spread, the maximum that can trade for is $10, which is the difference between the strikes, 51.60 and 51.50. So here we go. We're buying 51.50. We're selling 51.60. And right now we are up. We're up $1 on the trade. Market is at 51.90, and we are on Wednesday. We are quite a ways away. I like the way the market is going. I don't anticipate that. Well, there's nothing in the chart to say that we may come back down on this trade, but I think we might be in the wrong expiration. Yeah, there we go. Okay. So we have the 10th, and that would make it a little bit nicer, I got to admit. Okay, 51.60 wasn't out of the range, but let's clear all this out. 51.50, we're buying that, selling the 51.60, and now we're 7.85. Okay. Still not at maximum. Still have $2.15 to be at that maximum. We are on the Wednesday, and what needs to happen in order to get to the maximum is we need some of this time value, which is about $9. So this is the extrinsic value in this, to go away. So there's still $9 of time premium in this, and that's what's hurting our maximum gain. So from Wednesday to Thursday, you get a large amount of time decay in the S&P 500 index. And then obviously Thursday to Friday, everything has to go away. But time premium in the SPX is very stubborn. It just hangs around, which also makes it interesting to make an adjustment if you are wrong on your forecast. And last week, that's what we did. We had a 5-point wide spread. On Wednesday, the market had gone down, let's call it 1%. I don't remember exactly. And we adjusted by rolling into a butterfly. And big thing is that we could, because there was some time premium still in the option contracts, and it made it feasible to do it. And then by Friday, the market came back and actually touched our short strike Friday morning. So there's good and bad with the stubbornness of the time premium in the SPX. But when you're correct on your forecast, it's bad. Like, it's annoying that we still have $2.15 left in this trade before we can make the maximum on the trade. Now, so if we had the trade on right now, I would definitely have an order in to sell it at around 850. I'm happy to get 850 today. I'd let that order expire. It would be a 1-day order. And if I don't get it today, then I'm going to take the risk and go overnight and hopefully get $9 sometime on Thursday. That would be my plan for right now. So I'll take 850 today, but if we're going to go to tomorrow, we're going to get larger time decay, and hopefully we'll get the markets. Right now they're flat. We get the markets to give us a little bit of a bounce, and we can get out somewhere close to $9. And then once again, you got another overnight risk. You got to decide if you can't get that trade filled, or if the market goes against you a little bit, then you have to figure out what you want to do going into Friday. But if I do my long call spreads, which is a trade that I do often in the SPX, if I want to get bullish, this is the way I like to do it. And if I'm doing the long call spread, I'm instantly going to put in a good till canceled order to try to sell about 850. If I can ever get that early on, the first couple of days, I'm more than happy to take that and move on with the trade. Our total risk on the trade was 570, and we would do our roll if we could sell the short spread for around 250. And I mentioned that on the show on Monday and talked about what the adjustment would be. We're not going to have to make that adjustment, but if the market went down, what I'm willing to lose on this trade out of that $570 is around $2.50 to $3. And you have to make your decision where you want to be. But that's where I'm willing to risk on this trade, when I'm willing to do, if the markets are showing bullish conditions and we got a solid chart like we talked about on Monday. Okay, so then on Disney, and I'm just going to pull Disney up because that 60 cents is gone. The market bouncing a little bit today, but we came all the way down. If we look, let's look at the Disney chart. We came all the way down to about 110. So we're getting a little bit of a bounce back. And it's kind of nice that it broke up above. This is the 200-day, this is the 50-day, and this is the 20-day. And so a little bit of strength right here, breaking above that 50-day moving average. So that's looking solid a little bit in Disney. Don't mind the chart kind of filling this gap. This is where there's a lot of noise. And a lot of times right around this 20-day moving average here, there are quite a few candles that kind of hung out right in this range. And it looks like that is the area of, I don't know, contentment is the way I could look at it. And it looks like the stock is trying to pull up and take us back to that gap and trade in that range. So we were going into the earnings report, we were bullish on the trade, and that just didn't work out. So let's see what our strikes were. Let me pull it up. Okay, so we were 120, 125, and 130. And we did go 5 points wide. We got it done for 60 cents. So unless we still have some time in it. May 10th is the expiration date that we chose. So we still got a couple of days. But at this point in time, I don't even know if we can really adjust it. It was more, it went down, and it went down hard. These option contracts are going to be worthless. Well, let's go up and look at it here. 120, it's 0 cents by 2 cents. So you can't drive a car off the cliff and then take it to the body shop and say, please repair it. Knew that risk when we went into it. So that trade didn't work out this week. I really wanted to do a skip strike butterfly to try to protect us on the downside. And I just couldn't find one that I could pull off for a decent net credit to the account. Matter of fact, most of them were debits for the way that I was looking at them for the width. So that was that trade. Now, if you have any questions on these trades, first of all, and you put them in the chat box on the Tradier YouTube platform, I can try to address them. We're also streaming live on x.com. And we try to make this an interactive show. If you would like to interact during the show or have any questions on any strategies, ask them at any time. With that mentioned, we're going to now go and look at, let's back out a little bit. We're going to pull up the options playbook because, like I said, we're going to do a strategy here that I've definitely not done on Options Guy TV yet, and let's do it. I think it's NVIDIA is such a volatile stock. Maybe could have done it. Well, the market was down a little bit because now we're back up above the 900 level. But we're going to try to take advantage of the fact that earnings are coming. Our plan would be to be out of this trade. We're not going to try to make a home run on the trade. We're going to have a little bit of risk. We're going to have to put down a little bit of capital. And the thing is that the implied volatility and the fact that it'll probably go up as earnings approach, as the earnings date approaches on May 22nd. I don't want to be in the stock on May 22nd. I'm not going to say never, but my goal is to be out of it because I want the bump in implied volatility. I don't want to fight that bump in implied volatility. One way that we can do it is with a back spread with calls. Now, this is where I started, so I want to give you the process. And the stock would be right around where strike A is at. And strike B is, the dark hole the black hole in the universe. So you don't want the stock to stop there. And then you have unlimited upside if the stock takes off. Now, it's a volatile stock, so it's very wide between strike A and strike B. So, because of that, I decided, I don't know if I want to do that trade because I had to go too wide. So, I went to the options playbook and I decided, well, let's look at the skip strike butterfly with calls, where we're just going to take a butterfly and we're going to flip it upside down. And I'll show you the profit and loss graph for it, and you can make your own decision. But then that allowed me, by bringing in another credit, because here's the setup: we're going to sell a call with strike A, buy two with strike B. We'll skip over strike C, and we're giving ourselves some upside. So if we did get this movement, a huge movement to the upside, well, maybe we would ride it into earnings, but I don't think I want to, but maybe. Okay. And as this market goes up, though, and implied volatility stays high, it helps reduce a lot of this risk. And in order to show that, we're going to have to go to the what if calculator to look at that trade. Now, there's going to be a requirement from strike A to strike B that's going to be an issue. So we're going to have to put up some real money. But let's back out. This is the trade that we're going to look at inside the options playbook, optionsplaybook.com. And we will run to the TradeHawk software. And we're going to go out. So come on back. We're going to go out to the, well, that's the wrong stock. That's what's up. NVDA. So you see the difference in implied volatility here. And just highlighting the fact that we have an implied volatility of 50%, implied volatility of 46%, and here we have an IV of 70%. Now, if I do this trade and I just get out at break even, I'm okay with that. It's a speculative trade. But if we get a lot of movement to the upside, it can be an interesting trade. So we're going to have to put some money up front. We need a big move. And if the move's to the downside, oh well, not that big of a deal. We're going to get a decent net credit on the downside. If it moves to the upside, well, we're going to have to act quick and have to deal with this trade before the earnings report. So here it is. This is the May 24th expiration. We click on that. Make sure it says May 24th over here, 0524. Market's right at 900. So I'm going to probably have to adjust my trade a little bit. So we're going to go literally. We have the 54 strike. If we go down 50 points here, we go up 50 points. We're looking at $34. So we have to buy two of those. So we're looking at, I'm going to adjust this one a little bit. We're going to sell this, and this is going to do the lion's share of the work. We're going to buy two of these, and then we'll go, here's 50 points would be at 1,000. And another 50 points would be 45, 50. Okay, so we're going to have to sell. I want to bring in a little bit of a credit. We're going to sell the 50 30s here. Let's go one more down. 1030, I'm sorry. So let's do the 1025. All right, and let's send this to the what if calculator. All right, so we're not quite the same distance because we came down a little bit. So we're going to cut off the upside just a tad. But here's what we're looking at. You're going to have 25 points. So $2,500 is the requirement. And that's the risk from here on down to here. But if you look at the green line, we got, and by the way, I should have highlighted this. We're looking at $1. Well, right now, $1.50. It was $1.67 when we initially looked at the trade. We'll call it $1.50. Just make the math simple. So we're bringing in a net credit of $1.50. Our margin requirement is going to be $2,500. But we do not want to hang out anywhere in this range. And if implied volatility increases, the green line is what your focus is on. And that would actually drive this line up a little bit, giving us a little bit of protection along the way. So what we're hoping is that we can get some type of move towards the 950 mark and get out of the trade before the earnings report. If it goes down, say it went down 50 points over the next few days, over the next week or so, then we can make that net credit of $1.50. So on the downside, you can decide if you want to stick around or not. I would probably get out, not looking to make that that entire $1.50. If I could get out and make 75 cents on it because it came all the way down here, I would be happy to do so. But implied volatility is going to make that a little tough because of what's going to happen on the downside. You need some time decay and some movement in implied volatility, but we're hedged. If we go to the downside, there's not a lot. There's zero risk to us. Just have to close out the trade at some point in time. And I definitely don't want to get whiplash. Have the market come all the way down here, and then all of a sudden going into earnings, it ends up right here. So if it does come down, I'm going to take the risk off. We're just going to be in this trade for a week. We're going to see where the market goes heading into that earnings report, landing somewhere in here. Hopefully, at this point, if you look at the green over here, look at this little edge. It'll show you. Hopefully, we can get a little bit bump up in implied volatility. And if it got towards the 950 mark, you're looking at about a $300 profit as we move down. As a matter of fact, let's zoom in a little bit on here. It might be a little bit more straightforward. But if we get any type of movement in here, you have the potential to make a few $100s. So I'm not trying to knock it out of the park. It's a real requirement. If we get all the way up to this level, which would be a 100-point movement, which it's possible the underlying stock could do that. You're looking at about a $500 return at that point in time. It's looking at 586 over here or so. But if we got anywhere in this range, I'm going to try to take that trade off. We're going to do it on paper. I'm going to emphasize that. I want to see how it all plays out. This is an underlying stock that can move a lot going into earnings and obviously move a lot after earnings. They're in the news every day. The most talked about stock by all the other companies that announced earnings. And this is just a fun trade to do. As we get closer to the date, we'll do a more real trade, not necessarily a paper trade, but we're going to watch how this all plays out because it's going to be an interesting pricing scenario. And that's what we want. We want to have some fun here on Options Guide TV. All right. We've got quite a few comments at this point in time. All right. So let's go with the first one. And here's the question. Brian, would you consider doing the SPX trade that you made on Monday today? That way you do not need to adjust the trade while getting the time decay. Yes, I would consider it. Only because the market, I'm liking what you're seeing in the charts as far as the market is concerned. So let's run back to the SPX. So if you're doing it this way, it makes it really hard to adjust. Tomorrow, you got a possible adjustment that could be made, but as time decay erodes. But this is exactly what I'm talking about. If I grab a trend line and I draw it straight down here, you see we had a breakout and we're continuing fairly strong in that marketplace. This is once again where everything gets drawn to. There's a lot of bars just kind of hanging out here. So to me, that's basically value in the marketplace, right in this range. So I do think that it can make a push higher to the 52.50 range, but I always want to be able to have an adjustment in my pocket. I don't mind that trade. Like you said, time decay is if you get the same type of movement from Monday to Wednesday, you're going to be very happy on the trade because time decay is going to start withering away. I would definitely look at it by noon tomorrow, and maybe you could make that adjustment. Say the market was down 0.5% or so. You might be able to make the adjustment at that point in time. But no, I don't mind the trade right now because I don't mind the chart. All right. Since we're doing paper trades, what trades would you, okay. Since you are doing paper trades, what trades would you do on UPS or FedEx, TMO? and PLTR. All right. So I don't know if I got time to look at all of them. Can you do both? And then so we'll look at a couple of them. We'll pull up SPX or UPS and FedEx. I think is UPS. I think that's the symbol, right? Yep. So we'll look at that. Are they announcing earnings soon? Is that why we're looking at it? And then we'll look at FedEx. And then can you do the trades on NVIDIA and we can compare the trades at expiration? Can you do both the trades on NVIDIA? Well, we'll look at another trade closer to the date on NVIDIA. Oh, you want to do both strategies. You want to look at the inverse skip strike butterfly and the ratio, the 1/2 ratio. Okay, I mean, we can do that. We can look at it. How much time we got here? We got a few more minutes. All right, let's look at UPS and FedEx, and let's look at UPS. When are they announcing? I can look up here and see. 27th. It looks like right now they're looking to be announcing by this expiration. Is it after the close today? I have my notes in here. Let me see. I'm going to pull something into the market. The earnings whisper report. All right. So today. So we're not doing an earnings trade on UPS. You're just looking at a trade. Oh, okay. All right, that's fine. Yeah, I'm not seeing it. We will ignore those trades. We'll come back. We'll keep those stocks around, and we'll just talk about potential in those underlyings. Obviously, there's some interest, and then we'll look at NVIDIA and look at both of the strategies. So we have. Here's the thing about NVIDIA is if you look at that strategy, NVDA. Let's run to the what if. And you look at this one, we're going to have to get really wide if we don't sell this option contract, because the option contract that we're selling in NVIDIA right now is helping us out quite a bit. It's bringing in about, what was it, around $13 in premium. And that allowed us to have a credit if the market goes this direction. So by not selling this, that means that this gets a lot wider. How wide, you say? Well, let's jump back out here. Probably 100 points. I remember looking at it and being like, yeah, that's just too much. NVIDIA, we're going to go to the May expiration. We got $55. So the concept of just the ratio spread, the front spread on it, or the back spread, I guess, is we would be selling this option contract or somewhere in this range. As a matter of fact, I probably wouldn't sell that one. We would do like something a little cheaper. And then we're going to sell that when we got to keep the options that we're buying under half of this. So around $25. So how far out do I have to go? All the way down, all the way down. So we're at $9.85 before we get to $25. But then I would like to get a little bit of a credit in case the market went down. And so then you're looking at this trade right here. So I guess we could probably do the 85 because $3.75 is a real credit. Let's see. So $1.48. Yeah, I'm okay with that. So we've got $1.50 in the other trade, looking at $1.48 here. But now the width is 75 points. So you're gonna have to put up real money too. Our other strategy, the margin requirement was $2,500 for every 1/2/1 that we put on inverse skip strike. If we're looking at this trade, we're talking about, let's pull this up. We're talking about $75 requirement here. So we're looking from A down to B on the back spread with calls. And the margin requirement here, it shows you inside the playbook, is the difference between the strikes of the short call spread. Okay, so from here to here is the difference. And if we run back, and sorry to do this to you guys, we'll jump right back into the TradeHawk software. There we go. So we'd have 70. So the margin requirement's not even close. And hence the reason why I looked at the inverse skip strike for the trade. But I will take a screenshot of this and we'll look at both of them. We'll look at both of the trades. It's still going to be real interesting because of implied volatility. But you'd need a real move to hit a home run in this trade. Like you're talking, you need about 100 plus points. So look at how much wider it is in this range here, all the way down. So we need to get all the way up to, by expiration, 1,060. We do have unlimited upside. If we do get this move to the upside, we're looking strong, much stronger, because we don't have that one option contract that we're trying to fight with. But we have 75 points of risk margin requirement that we're going to have to put up on every 1/2 back spread that we put on. So there you have it. Great question. We'll look at them both. And I'll write down the other stocks, and maybe we'll look at those type of trades. Those like UPS and FedEx, those are stocks that I would probably look in our deep in the money call portfolio. I wouldn't mind maybe adding a one of those to that portfolio that we have. Right now we have Google in there. We have NVIDIA is one of the stocks that we bought way deep into money options. Eli Lilly, Caterpillar, FedEx, or UPS would be two stocks I might look to add to that portfolio. All right. That's it for this edition of Options Guy TV. Thanks for coming by. Very speculative trade. It's going to be a fun trade to watch. We're doing it on purpose before the earnings date because implied volatility is our friend here. It helps us out if the underlying, if it increases because we own two of these option contracts. So that increase as the earnings date approach can help us out on the trade if we're starting to go this direction. And we'll see you Wednesday. No, okay. So we're Wednesday. We'll see you Friday for the next edition of Options Guy TV. Please click subscribe, ring the bell, 11 a.m. Eastern time. Hope to see you there.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.